This is a podcast from the Business Times.
Money makes the world go round, the world go round, the world.
Loud budgeting is a trend that's gained a lot of traction on social media, most notably TikTok.
Loud budgeting is in.
You remember that old saying, if you've got it, flaunt it? Well, now, according to Gen Zers, the new phrase is, if you don't got it, flaunt it.
Money dysmorphia.
Loud budgeting, soft life, money dysmorphia. We're scratching our heads and yet feeling as though there's something vaguely familiar about these terms. We suspect some of these Gen Z money trends are actually boomer financial fads in cuter outfits. This is Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. CMC Invest's head of Singapore, Christopher Forbes, joins us to make sense of it all.
First of all, thanks for having me on. You're dead right. It's a big TikTok craze now. I think if you look at the generational shift, at least in my generation as an old man now, Gen X or boomers, we weren't comfortable talking about money. We weren't comfortable talking about salary. We were told buy a house first and then worry about the luxury side or the disposable income side of your wealth. I think as the Gen Y, that social media side of generation, they're much more comfortable about talking about money, and loud budgeting is exactly what it sounds like. It's having that proactive, transparent, audible approach to saying, this is what I will do with my money. This is how I will spend it, and being very methodical and transparent. And I think it's a great thing to have, even to the point where, again, if we went for dinner in our generation, one person, traditionally the father figure, would pick up the tab, rightly or wrongly. But if you go to the modern generation, they're very comfortable with saying, hey, we split it 10 ways, or we don't play credit card roulette per se, but at least we'll say, well, we'll itemize it. And so there's a very different approach to how we view wealth. And part of that generational shift is transparent communication, and the attachment to money is very, very different. I put a lot of that down to social media.
So one generation's loud budgeting is another's Excel spreadsheet.
Yes, but having the confidence to speak about that. But if you budget, you within reason have a good sense of what disposable income you have. Whereas I don't think the previous generation did budgeting very well. I think what they did was they look at their bank account and say, well, I've got X left. Whereas I think the modern generation or anyone semi-savvy with Excel will say, I will budget according to this, and therefore I know what percentage of disposable income I have at the end of each month. And then you see the sort of doom spending as a result of that.
Doom spending is when our anxiety and worries about the economy triggers us to spend money so we could live more in the moment to ease our stress.
So doom spending, just by its name, doesn't sound like it's a good idea, right?
Well, it's a good idea if you know how much disposable income you have. I think what we're seeing more and more, and I think Singapore is a brilliant example of this, and the US as well, luxury brands, and you can look at LVMH as a great example, as a barometer, or Kering, or any number of luxury listed brands. Their earnings have been superb, propped up by China, which we know is not as strong as it was, but people love luxury. We have Orchard Road in Singapore and a number of other shops in Marina Bay. There are no discounts. You have to queue to get in more often than not. Every Christmas anniversary, etc., it becomes a bit of a showing off phase. And so that doom spending of going in to buy luxury in copying that New York style spending pattern, it exists especially in Gen Z and Gen Y. We're certainly seeing a lot of spending. Small items, but big ticket, big price items. And again, the fashion from Gen Z to Gen X to boomers and millennials, we don't wear branded clothing. Your brands are inside your blazer, for example. The current generation plasters it everywhere, and they are prepared to pay high prices for that. And so you're seeing that doom spending. And the best way to look at that, if I'm honest, from a financial perspective, is one, the share prices of those listed companies. Secondly, you can look at credit card issuance and credit card debt. It's at record highs. Margin lending is at record highs. Household savings is at record lows. So we are seeing doom spending play out. And the best barometer is look at the banks. Most of their high margin lending, the high ROE lending, and look at DBS as a good barometer. It's not people buying mortgages and they clip a small percentage on that, or 1.5%, 2%. They're issuing credit cards at 18% APR or car loans at 18% APR. That's where all of the growth in financial services is coming. It's from that doom spending credit card type debt.
Speaking of luxury, there's another trend that's called quiet luxury, which was so last year apparently. And loud budgeting is the antithesis of this quiet luxury. What do you reckon, Chris?
That refers to this notion of soft life, and soft life refers to exactly what it sounds like. It's having a not easy life, but living a much more fulfilled, quiet life. You're not wearing those big brands externally. You're not buying the new watch. You're not going out partying every week. It's much more about having a sustainable, eco-friendly, manageable life. So you're budgeting, you're eating sustainable foods, you're perhaps growing foods, you're not going out dining constantly. You're really watching how you live your life. This notion, soft life, is what you're referring to. Yes, we're seeing it. It's not a huge thing in Singapore from what we see or what I believe trends, and I'm certainly not seeing it in any of the data that we pick up on.
Money dysmorphia, a financial state where self-perception doesn't match reality.
Is the distorted view that many of us have of our finances that causes us to make poor decisions about our non-renewable resources, time, energy, attention, health, relationships.
It sounds like an American term. And again, sort of a social media term. You can kind of see it through some of these buy now, pay later type of businesses. Most businesses have them now. Any sort of lending business has a buy now, pay later. Credit Karma is a good example. I think Grab has just introduced one in Singapore. Australia has a few. Effectively, it's how you perceive your financial picture versus someone else. And again, if you compare yourself to others, you're constantly going to have this money dysmorphia. And that creates competition, jealousy, boom spending. And yes, you're right. It's a huge trend. It's not a healthy trend, to be honest, because competition is the enemy of satisfaction. And so you don't really want that money dysmorphia, but it's a very interesting social media-led trend, unfortunately, that I think has led to lots of sort of buy now, pay later popularity. It's not a healthy trend.
Still to come, more Gen Z money trends unearthed and dissected. How effective are they really? Back in a moment.
Money Hacks now comes to you every Monday. Get useful financial tips every week. How much to save? What to invest in? Howie Lim asks the experts, so you have the answers. Money Hacks by the Business Times. Every Monday, go to bt.sg/moneyhacks or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
We've covered loud budgeting, which is essentially being proud to announce and to state up front that you're on a budget. Also doom spending, which is when our anxiety and worries about the economy triggers us to spend money so we can live more in the moment to ease our stress. It's starting to sound a little as if we oldies are just going on about how we find new trends disturbing. Christopher Forbes of CMC Invest and I are both Gen X. How do the younger feel then? Here's Seth, client advisor from Providend.
As with most generations, there are some habits that are good and some that are not that desirable. It's just that perhaps I think in Gen Z era, or the era we live in right now, right, social media has really amplified a lot of these trends. So some are good and some are not that good. On loud budgeting specifically, I actually think that it is not too bad an idea. I mean, I could be biased because I run my own YouTube channel where I talk about my own money habits, right? But I think that that's one positive example, because if you are actually talking about how you budget, one, it makes you accountable to your followers and viewers who can then say, hey, you said you're going to spend only this much, last month, but you exceed your budget. So it keeps you accountable. And another, I think it just makes you more conscious about your spending when you're more deliberate about it. And I think thirdly, it helps other people be more aware about their own spending habits. So I would say there are good and bad things that have come out, in our TikTok generation. The encouraging thing is that at least I think financial prudence is also being encouraged in quite a lot of videos that I've seen.
Not as decrepit in my thinking as you thought, huh? And how different, generally speaking, are the money habits of the generations, Chris?
Oh, it's huge. So again, old man.
Oh, come on.
We were told, buy a house, save for holidays, invest into, at the time when we were being brought up, ETFs was the new buzzword. And so you were always told by Warren Buffett and a lot of the other market players with wisdom, invest in an ETF and just let it compound. And there's a lot of wisdom in that, to be honest. It's worked and will continue to work. You generally had a private banker. You generally did some sort of spreadsheeting. A lot of stuff in Singapore specifically is cash stuffing. So people put their money into fixed deposits or bond funds that will yield 3 to 4%. And they're very happy with that return because it was always above inflation. Where now, I think where inflation or CPI has been 4 or 5% and interest rates have been 4 or 5%, that cash stuffing has not worked in Singapore. We're still seeing the huge inflow into money market funds, but I think that's peaked, if I'm honest. Traditionally, Asian countries buy real estate, gold, and cash. So fixed deposits, when I say that, they're the three sort of main investments. I think if you look at the newer generation, everyone has an Apple Watch. Everyone wants a Tesla. Everyone wants a nice dress watch. So you're seeing that luxury side to their spending. They do the loud budgeting. So they're very open and transparent about money and how they spend it, how they save it. We are not seeing a huge amount of cash investing. And what we see instead is lots of meme stock investing, much higher risk, social media led Reddit type of, hey, I got this tip. I'm going to buy this stock. And often you can, if you ask them, what does that company do? They often don't know. Therein lies a bigger issue for me, that you're investing semi-blindly. You're just following trends. That it's a bit like a Ponzi scheme. It's fine if you're in first, but if you're out last, that's a real worry.
No due diligence on that part?
Very little due diligence. Very little due diligence. And again, Monday's our busiest day. Why? Because they've spent the weekend on social media generally, or speaking to someone to get tips. And so Monday we're very busy. And again, that's not a great outcome for young investors. You always have to do your homework. You need to know roughly what are the earnings, what is the CEO, what is the vision, how are they going to achieve that, what do we think the next few quarters, if not years, of earnings will be, etc. You need that big picture thinking and some basic fundamentals, I think, to make sensible investments. Or you go down the ETF route. But not having either, it's a bit more akin to gambling.
Yeah,
the other thing was,
if you're not going to do due diligence, and then don't come loud crying to me, because it is a case of buyer beware, right?
Completely. 100% is. And therein lies some of the, as I say, the Gen Y versus Gen X and boomers. They're the big differences. The biggest difference I see is sort of broadsheet content, reading of news, studying versus social media investing. And then I think the older generation are a lot more comfortable, either via wisdom or old age, in themselves, what they wear, how they dress, how they come across. Whereas I think a lot of that newer generation is still, I'm sure we were all there on that journey of wanting to wear the best luxury brand, become the early adopters of the next Apple product, as an example, where those initial early adopters had much more wealth and had their home paid off. And so you're seeing children live with their parents for longer globally because they can't afford to move out. Interest rates at 5-6%, when the bank puts its margin on top, borrowing at 8% versus a year ago at 2%. It's a huge difference in how you repay your mortgage, how you repay your credit card debt. So again, it's become very tricky for Gen Y. So they're not getting on the ladder. They're investing into meme stocks. We're seeing a huge amount of allocation into sort of crypto-led currencies or crypto-led businesses, whether they be exchanges or custodians or data centers where a lot of the mining happens. It's much more going down the risk curve to get that dopamine social media hit, in terms of you get that instant reaction from social media. We're seeing that in stocks. We want to put in a small amount to get a huge return. So it's much more short-term thinking as opposed to the older generation that's a bit more longer-term thinking, more compounding.
Your advice to the various generations, you reckon it be the same, or would it be specific, say, for the Zs, the Ys, and the Xs?
So the best advice I can give is that, money is personal. And I've seen very young, inexperienced investors approach me and say, how can I have a safe return that will compound? And by the time I'm 50, I'll have a nest egg. And I think that's incredibly wise. I also get, hey, Chris, I've got X. I'd like to make 50% return year on year. What? And if you look at the best investors in the world, they're generally returning something like between, on average, the S&P is around 10. If you have a managed, balanced portfolio, so some real estate, some gold, some credit, some rates, and some equities, you're looking around 5 to 6% before fees. So to get 50%, and I think Renaissance Capital, one of the biggest, Gene Simmons hedge fund, I think its flagship Medallion fund has returned something like 36 to 38% net of fees year on year, so CAGR for young investors to say, hey, I want 50% return, it's just unrealistic. And this is where that money dysmorphia we talked about plays an unfair part in managing the expectations of the younger generation. I think if you can get 10% return per year, you're doing very, very well.
Yeah, my Gen X eyebrows raised in skepticism. Chris, I wish we had more time. Thank you so much for your insights today.
Thank you so much for having me on.
Christopher Forbes, head of Singapore at CMC Invest. And also thank you to Seth Wee from Providend. This has been Money Hacks for the Business Times. I'm Howie Lim. Till next time.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.